These are the investment vehicles which you can use to invest in segregated funds. So segregated funds can be used in any of these forms and forms.
Simplify it down.
Okay, I'll talk in a layman term.
Yeah, thank you.
So you got your first advantage, that is it gives you it protects your principal as well as it protects your interest, right? And even if there is a market downturn, let's say there's a market crash, you are guaranteed 75% or 100% depending on what you choose of your interest. Thank you for that question, and good you brought this topic up, because we have a preconceived notion here that it's only real estate that is a good investment and there are not many other investments in this current situation or in this market. But my objective today is to demystify that notion that apart from real estate, there are so many other options.
Namaskaram everyone. Thank you so much for tuning in to CLTV Podcast. Thanks a lot for giving me your time and watching this conversation today. It means a lot. CLTV Podcast is about having conversations, learning new stuff for a better and successful life. In that process, I have asked Amar, who is by profession a project manager as well as a financial advisor. Amar has guided lots of people to achieve their financial independence, success, and lead a better life. I have discussed various simple strategies with Amar. What is the best way that we can invest in this great nation and make our lives better and others' lives better as well? So let's dive into this conversation. Enjoy.
Hi Amar, welcome back to CLTV Podcast, sir.
Thank you, Shashank.
And I appreciate you wearing investment advisor hat for me now for the second podcast.
Oh, looking forward to this one now.
Beautiful. I really wanted to focus more on investments which are outside real estate. More specifically in the because real estate investments are quite clear and they are more popular as investment options in Canada. What are the other investment options we have in Canada, and are there any specific investment options which you want to bring it up today?
Thank you, Sashank, for that question, and good you brought this topic up, because we have a preconceived notion here that it's only real estate that is a good investment and there are not many other investments in this current situation or in this market. But my objective today is to demystify that notion that apart from real estate, there are so many other options that one can utilize, and based on three things, which is your risk profile, your returns that you're looking for, and of course your goal. Now, we all have personal goals, we all have professional goals, but we lack financial goals. So along with your other goals, you should also have financial goals. And those financial goals, when you put a deadline, when you put a timeline to it, you will be able to achieve it. So today I'm going to talk about those alternate investments and how we can utilize that investments as per the Canadian law.
Beautiful. So I was under perception that, besides real estate, we have stocks, obviously. Stocks, can that be considered as investment? I think they do, right?
They are considered as investment, but as I said earlier, based on what you are looking for and what you want to achieve for, you can use. So stock is just one portion, which people trade and people use apps, or people do it on their daily trading platform and utilize that platform. Today, my focus is to talk about something which not many of us have heard, which is called segregated funds.
Oh, okay.
Now, what are segregated funds? They are sort of managed by different financial institutions, and that comes under the umbrella of a financial institution where they are managed separately. Hence, they are called segregated funds. They are very similar to your ETFs, equities, mutual funds. So, in short, you can say that they are sort of mutual funds, but with additional protection or additional advantage. And one of the biggest advantage that a segregated fund has is it gives you guaranteed returns, as well as your principal is always safe and secured, as compared to a stock where if you invest, you might have a chance of losing everything as well.
Oh, okay.
Right?
Yeah.
So depending on your risk profile, you can go with it. But segregated funds is sort of the way to go. And it is, I see the future of investing. Now, what happens is, apart from just the major, there are many, many other benefits, which we will talk. But my first focus is the cash or the cash equivalents that you can utilize apart from real estate investing. So these are your bonds, your GICs that, a financial institution or a bank might provide to you. Their features are very close to safe haven. They do not give you higher returns, but they don't even give you a loss as well.
Okay. So
they play around between the inflation, what the inflation rate is. Right now, the inflation rate is 1.92%. So you would get around 2% or 3% max. And then that's where you are happy. So this is for an investor who's very conservative, who wants to have that liquidity in his account, and he wants to have access to that money whenever he or she wants it. So it's for certain investors. And of course, the financial goal here is very short. Probably you are going to withdraw this money in the next 6 months, 8 months to a year.
Okay.
Right? Then the next one above the cash equivalence comes is equities.
Okay.
Or you could say bonds. So bonds are again the same thing. You can go it through a financial institution, through banks. They might give you a little higher rate of return than in inflation. Could be 3%, 2.5%. But again, not very, very conservative, but probably a moderate way of earning money and making sure that your, again, principal is not lost, but you're not even gaining a higher return.
Okay.
Right?
So, in this category, where does RRSP and TFSA, RRSP is not an investment option, I guess. So, where does these things fall into picture?
Good question. You brought these accounts which are given by CRA. So TFSA, I would be categorizing under short-term liquid cash because I want to access that money whenever possible. So I might not look more than 3 to 4%, or maximum I would say is get me 5% rate of return. So now when I know I want to use that money, I can utilize that money whenever I want because it's my liquid cash. My RRSP, and again, TFSA is for my short-term goal. My RRSP is for a long-term goal. So with my RRSP, I can go aggressive because I have time to recover even if there is a market downturn.
What do you mean by going aggressive with RRSP?
So RRSPs would be, for example, I'll take my example. I have another 20 to 25 years to my retirement, which is the age of 65.
Okay.
Now, since I have that much of time, I don't want just a nominal rate of return of 3% or 4%. I want something where I can get a higher rate of return. Yes, my risks would also be elevated, but I know that even if there is a market downturn, I have another 5 years, 10 years, 15 years to recover that money.
No, I'm just trying to understand like RRSP. If I put in RRSP, is there how does it even work? Like,
absolutely.
Does it go? They go and invest somewhere,
right?
Like what
so RRSP, how it's calculated or how it works is it reduces your income, thus it will give you tax credits. Now, as you know, everybody is talking about it. It's RRSP season because you can contribute towards your RRSP account for last year until March 3rd of this year, which is 2025. Now, how RRSP works is it is calculated upon 18% of your annual income.
Okay.
So let's assume my income is 100K annually. So I have $18,000 limit where I can invest. Thus, my income for that entire year reduces and I will be getting tax credits from the CRA once after filing taxes. And that's how RRSP works. Now, when I invest in RRSP, where am I investing? Yes, you have two plans. One is your group RRSP plan, which is given by your employer, where you would say you would contribute and probably employer would match or they would have those plans. But you can also have your personal RRSP that now I want to focus towards my retirement, which is in the next 20 years or 25 years. And how do I achieve that financial goal? So how I count RRSP is always times 20 of your annual income. Yeah, so that there is a formula that if I want to know what is my RRSP income or what is my RRSP growth should be there when I retire, I should multiply my current income net times 20. So let's assume my income is 100K annually and net is 70K after taxes. So 70 times 20, 1.4 million should be in my account the day I retire. So I can survive for the next 20 years, 25 years from the age of 65.
Okay.
Right? Okay. So that's how your financial goal is. Now you have a number. So now you work towards that number. So now you do a backtrack that, okay, if I want to achieve 1.4 million in my account by the time I'm 65 and I have these many years, what do I need to start now? And how do I start? What is the rate of return that I should work with? Now, you have to again choose as per your risk profile, as per your financial goal, and as per the options available. So that's where comes is the segregated funds way, where you can invest in ETFs, you can invest in sectors such as healthcare, IT technology, construction, banking, and it's not only limited to Canadian market or Canadian equity, but you are exposed to the US equity, which is always doing great.
You can invest RRSP in US?
Absolutely.
Okay.
You can invest in a Canadian RRSP account, but with US equities, right?
But it has to go through Canadian,
yes. So, right. So, but you are gaining those returns that is in the US market or in the European market or in the Pan-Asia market or the global market.
Got it.
Right? So, don't just limit yourself to just one financial institution or one product. You have to do your research. You have to know what are my options out there. You have to know what are some of the things which will work for me and my family and which are some of the things which are not work for me.
Beautiful.
We follow that, sorry for my language, the monkey see, monkey do, right? Or he did this, so I'm just going to copy, paste. But your financial goal is different from my financial goal.
Yeah.
Your risk profile is different from my risk profile. So it will never be the same. So you have to know what you want, what your goals are, and accordingly you work towards it.
Beautiful.
I have not even discussed the advantages and few of the other benefits that a segregated fund has, which of course I will talk about soon.
Yeah, we'll go there. So because RRSP is or something which have been, sorry, I took you to the tangent of RRSP here, but I just want to close it up for benefit of everyone because it's pretty well-known thing, right? So RRSP through company is one way of making investment. That is like you share something of some amount of your salary, and then the organization puts some amount, right? So how about the people who are into self-employment? Like, what is that RRSP options?
Great question. So as a self-employed or a business owner, you can also contribute to your RRSP plan, and that would reduce your income. Thus, you will be getting tax returns or tax rebates from CRA. Okay. Now, based on your income of your business, you can do is 18%, but there is also a cap to it. And I believe for this year's cap is 35,000. That is the maximum you can contribute towards the RRSP. And then once you over contribute, you will not get those tax rebates or tax credits.
And that's all 35,000. That will be out of your taxable income.
Correct, out of the taxable income.
Rest will be taxed.
Absolutely, but that reduces your income. So imagine if I am making 100K income as a business owner, I will be paying a heavy taxes of let's say 30 to 40%.
Yeah.
But now I invested let's say 20,000 in my RRSP. That has reduced my income to 80,000. So now CRA will only tax me on 80,000 and not 100,000.
That's a good thing what I guess government has done for us.
Absolutely.
That's okay. Sorry, go ahead. That RRSP thing is closed. Now let's go back to the...
Right. So now the same thing you can do it with TFSA, which is going to be a liquid cash, which you can again TFSA do the segregated funds way, where you are not only focusing on GICs and bonds, that is giving you 2% or 3%, but you can get a little higher rate of return, being conservative, but also getting 4% and 5%. Now, the segregated fund way is how it works is, once you go through that, as I told you before, it is sort of a mutual funds, but you get your additional protection, which is your principal is always safe. You get your guaranteed returns if you've taken that one. And also you can assign a beneficiary, which you cannot assign in few other investment portfolios and strategies, right? As you know, real estate, yes, your primary home is 100% tax free or capital gains free. But if you have an investment property, you end up paying heavy capital gains taxes. So to stay away from those capital gains, segregated funds would be the best option, where your investment is protected, your growth is protected. Also, the money or the growth or the principal goes through the beneficiary, because here you can assign a beneficiary, whereas other accounts you cannot assign a beneficiary. Now, when I say beneficiary, that means it is protected from creditors. Now, creditors,
it's all flowing over my head.
Right?
So you would have to explain me
absolutely
like a layman. So segregated funds, beneficiaries, and protectors. How it's flowing over my head. Please simplify it down.
Okay, I'll talk in a layman term.
Yeah, thank you.
So you got your first advantage, that is it gives you it protects your principal as well as it protects your interest, right? And even if there is a market downturn, let's say there is a market crash, you are guaranteed 75% or 100% depending on what you choose of your investment, right?
Okay.
So that's the biggest advantage that happens. On top of that, segregated funds are creditor protected. So that means if a business owner gets bankrupt, nobody or no creditor can come after the bankruptcy or the company or this particular amount, because it has a beneficiary attached to it. So only the beneficiary or the owner can touch that money.
Okay, let's slow it down. So explain to me, let's say a person X has invested through segregated funds into ABC company.
Correct.
Okay. So not Alphabet, ABC, it's a fake company. Okay. So what happens now is, let's say ABC company goes bankrupt. The people who have given money to ABC will not own your money, the person X money, right?
So not the ABC company.
Okay.
So let's say a business owner, ABC business company has done his RRSP through.
No. ABC is the X is the business owner. So
X is the business owner.
ABC is the company.
So X is the business owner. Now he just took an RRSP. For example, through the segregated funds way.
Oh,
right.
Wait a second. No, now I was under perception that RRSP is different and segregated funds is different.
No. So through
Sorry,
RRSP, through TFSA, through RESP, through FHSA, these are the investment vehicles which you can use to invest in segregated funds. So segregated funds can be used in any of these forms and formats. It doesn't have to be RRSP. It doesn't have to be TFSA. But you can take that route. So instead of you opening a TFSA account with GIC, you can open a TFSA account with segregated fund investments.
Okay. I know up until GIC, but now now I understand now. So let's say if let's pick up TFSA. Okay.
Yeah.
I have a TFSA account, and that account I use to invest in segregated funds.
Correct.
Okay. Now take me through that.
Right. So now since you are invested through the segregated funds.
From TFSA, segregated
to
funds.
segregated funds. Now you can choose which industry you want to go into.
Okay.
You can choose IT, you can choose healthcare, you can choose banking. You can choose multiple equities. If your risk profile is low, you can choose bonds. If your risk profile is high, you can choose high equity companies, which will give you a higher returns.
Okay.
Now, what happens as a person when he or she invests into segregated funds through any of these accounts, segregated funds, they don't fall under the umbrella of being in case of a bankruptcy.
Explain that to me.
Right. So let's assume I had a TFSA account and I owned a company. Now my company went bankrupt and I have $50,000 in my TFSA account. If it was a regular account, the bank would have come against that account. But since it is through segregated funds, the creditors, it is creditor protected. Creditors cannot touch that money.
It's about the person who is investing. It's not about the company where you're...
Right.
That's where I was confused.
Yeah, so it is creditor protected. Now only the beneficiary who's part of the TFSA can touch that money. A simple example would be, let's say I have my RRSP and my beneficiary in my RRSP account is my wife.
Okay.
And I pass away tomorrow. What happens is now my debts or my creditors or banks might come against my investments.
Whatever amount we have.
But they cannot touch because my wife is the beneficiary.
Yeah.
So only she can utilize or touch that money.
Oh, it's kind of, it's a security.
Security, yes,
for
absolutely.
the beneficiary. Then.
Right, for the beneficiary.
As
so
well
it
as an
always,
investment.
yes, it always works on behalf of the investor. Also, the other benefit that it has is it bypasses probate. So in
probate?
Canada,
Sorry, you're talking to completely layman.
No,
because all my stuff is taken care by my wife.
No,
so you have to explain to me.
So in
Or
Canada,
maybe I know it. I'm just acting dumb. So help me out.
Yeah. So in Canada, there is something called estate tax, estate law, probate fees. What happens is whenever a person is alive, all his assets, his bonds, his house, his everything is an asset. Once a person dies, those things become estate. So they go into estate.
Yes.
And that's where the probate code, probate officer, estate law applies. And that every person living in Canada has to go through. Now, when you have invested through segregated funds way, you can bypass this probate and this estate.
What happens in probate?
Right. So probate is something where it has to go through a probate officer, and then they will say that based on your asset value, this is the amount of tax that you have to give to the final CRA
before it goes to the beneficiary.
Before it goes to the beneficiary. So that process is very long. Now, if you go through the segregated funds way, the money goes to the beneficiary right away the moment the person passes away, and it bypasses all these probate.
It is it acts as a protection
against
for the family.
Yes,
family
for the family,
or the beneficiary.
And it's easy to access. Now, what happens is when a person passes away, the family is already grieving through a loss, but now they are also facing financial loss because of the funeral cost and the funeral expenses and things like that. At that point of time, they need that cash in hand. So now, in no time, they always say in 5 to 7 business days, the beneficiary gets the money and they can utilize that money for whatever it is.
I never expected, in my investment podcast, I'm going to discuss about this, but that's very important.
It is important, but people don't talk
really
about it.
Yeah.
It's going to happen eventually to everybody, right? So why not talk about it and be prepared? Because again, you have to be proactive rather than being reactive.
Yeah, it makes sense, right? Like when you and it's completely approved by the government.
Absolutely.
Within the framework of law,
Absolutely.
you are allowed to protect your family.
That's right.
Through the segregated funds.
That's right.
You have the vehicles, as you said, RRSP, RESP, and
TFSAs, FHSAs.
I don't know if FHSA. Again, I would have to ask you questions more, but I don't want to go there. So let's focus on these 3 things which are popular: RRSP, RESP, and TFSA.
Yes, yeah.
So these 3 things are the vehicles which you can use and protect your family.
Absolutely.
Right?
Yes.
That's
so I always say, if a person is 19 and if a person holds a SIN number, they should open up a TFSA account, because that is sort of getting into the game, understanding the market, understanding how investing works, and understanding what are some of the available strategies that you can apply. Once you become confident in managing your own TFSA account, then you can start with RRSP and of course your kids' RESP, which is very important for kids' education, right? So these are some of the funds which are available in the market, but people don't take advantage of it. Another advantage of RESP is, I'm sure people know, but some are not aware, is you get free grants from the government. So if you don't have an RESP account for your kid, that means you are losing out on that free money.
Because government wants your kid to
Absolutely.
go and get a good education.
Absolutely.
Right?
Right.
Nice.
So these are some of the things which we have to be more, sorry to say, but I came across a family where the father doesn't want to open an RESP account, thinking that, oh, don't worry, I have 2 houses. I'll sell one of the houses when my kid is 17 or 18. Now, do you know when that kid turns 17 or 18, what is the real estate market is going to be? What if we are in a big, huge crash? And at that point of time, you're not going to tell your son or daughter that don't go to university this year. Wait till the market gets better and then I will sell the house. No, it doesn't work that way, right?
Very true.
But everybody has a different way of thinking. Everybody have a different set of priorities. So you have to make sure that what is your priority, right? You have to make sure what you want to go for it.
Oh, beautiful. So because you brought up this point of estate, do you have knowledge of why do we need this estate planning? Like, can you take us through very briefly about it?
Yeah. So estate planning is nothing but, as I said, whatever you currently own when you're alive is your assets, such as your house, your car, your bank accounts. Let's say you're doing stocks, you're doing trading, or everything, right? Once you die, that asset goes to estate. Now in Canada, everybody has to go through estate law. Now estate law is being managed by a court called probate court.
Okay.
So you have to go through probate. Now probate court has probate officer. Now when a person dies, the system has to go through, the person's documents and assets has to go through probate court, probate officer, to make sure what are the final taxes that the deceased has to give. Right? Now, after the final taxes are given, taken care of, what is remaining, then it goes to the next of kin or the beneficiary. Now, first thing how it happens is when a person, let's say between husband and wife, they made 1 million and husband passed away, everything goes to wife and it's called spousal rollover, but there are no tax implication because the money was generated between husband and wife together.
Okay.
Now, once the surviving spouse or the mother or the father passes away and the asset or has to go through the next generation, there is huge tax implications. So to avoid that, you have to go the segregated funds way, where you can assign a beneficiary. So it bypasses the estate, bypasses the taxes. You have to still pay the taxes, but your money is given to you right away. And then the beneficiary has the ability to give out all the taxes, to give out the creditors, to give out all the debt.
Got it.
Right? So now the beneficiary is in control of how to disperse the expenses rather than somebody else being in control. So it is a very sensitive topic which people don't want to talk about it, but they will go through it.
Right? So in which part does it come into estate planning? So the estate planning is something which do I have to, how does it even happen?
Right. So you can sit with an advisor or work on starting with. So the first step towards estate planning is will preparation.
Okay.
Will preparation is nothing but you want to make sure that once I pass away, who's gonna get what, right? Now, again, if you have a will, the probate officer will follow your will. If you don't have a will, the probate officer will just put a default will. Right?
Okay.
Right. So you have to make sure that you have the right will structure, you have the right things, and you have added your assets to your will. And will is not something which you will just do once and you forget it. It's sort of a review that you have to do with your spouse, with your family, because things change. Today you have one house, tomorrow you have two houses. Now you have a business. Now you had one more kid. So things change. So that's why it's always good to review these will. Now, there are a lot of options available online. You can create your own will. There are automated will as well. But you can also connect with lawyers or advisors who can help you in preparing will. Once you have that will, then you can say that, okay, my probate officer will follow this. And now this has to go to this. And then it will make sure that the beneficiary gets it right away. So that's one of the benefits of having a segregated funds. Another benefit of segregated funds is any loss that you incur in a segregated fund, you can apply it as a tax benefit because it's a loss to you. So you get a T3 slip at the end of the year if you have invested, and you would say that, okay, I had invested $100, but I only made $80, so $20 is my loss. I will get tax rebate for my loss on segregated funds. And finally, there are plans that you can utilize which will give you guaranteed income for life till the time you die, and whatever remaining amount is left or remaining will go to your beneficiary or spouse. So you have to make sure that you take full advantage of it. Why you don't know? Because people don't talk about it. Because financial institutions don't want you to manage your own money. They want you to manage, they want them to manage your money. So the more you know, the better decisions you can take, and then you can achieve your financial goals.
Beautiful. So looks like segregated funds is something very less known, but has a lot of benefits to it.
Absolutely.
So what are the other options we have as an investor besides segregated funds?
Yeah. I'm not sure if you are into crypto. That is something which is very popular.
I'm into it, but I have not taken good decisions.
Yes, of course. So crypto is unregulated market. So that's why some people stay away from it. Some people want it because, of course, it's high risk, high returns. So there's hedge funds, which if you have the big investment or if you have a big portfolio, you can have a hedge fund manager.
Let's talk about hedge funds like a little deeper. So what exactly is hedge funds, and what is do we have any minimum limit?
Right. So hedge funds is, of course, for high net worth clients, and a lot of financial institutions have their separate banking division where they will manage, let's say, $1 million or $2 million for you, and they will make sure that hedge fund is sort of investing into these companies or organizations which are giving you good returns, good dividends, and then based on your investment portfolio, your returns, of course, your financial goal, you get those money back. The other thing is venture capitalist, which is sort of angel investing, where you found some IT company or a company which is in incubation stage and you see a huge potential to it. You can become an angel investor or a venture capitalist and expect returns in the next 5 years.
But these are all the high amount.
High net worth, right? But for us, the middle income, where husband and wife are working, we have our income, but we want to make sure that the money that we bring in, we want that money to work for ourselves. Now, our middle income mindset is we always think that we work for money, we give our time and we make money. But once you understand the concept of how money can work for you, because money is the only thing that can work 24/7. The moment you understand how money should work when you sleep, that is when you can call yourself an investor and start doing it slowly, bit by bit. I've come across many clients and many people saying, oh, I can't invest because I don't have money. No, you can start with a $50 plan. You can start with a $25 plan. You can start with a $100 plan. That will boost your confidence. Once you start making money, once you see results, once you see those bank accounts, and then slowly and gradually you can start increasing your investing growth. Another thing is you diversify. Again, you've heard is you don't put everything in your eggs in one basket. You diversify, you strategize. Real estate is your portfolio. Add it to your portfolio. Personally, I don't have a real estate portfolio. We just have one house, and that's what we focus on. We don't have multiple sources of income from the rental market. But yes, my portfolio is more towards the segregated funds, where I have my RRSPs, my TFSAs, my RRSPs, and few other investment strategies that you can utilize as well, where the growth is high. And then, of course, I know what I'm getting after 10 years, after 15 years, after 20 years. Yes, a little variation might occur, but I'm okay with that too.
Beautiful. So let's focus more on segregated funds in my last question now. So not last but one. So can I plan retirement, early retirement, based on segregated funds?
Absolutely.
So take me through that. What are the step-by-step things which a person has to do to plan early retirement, probably at age of, let's say, if they're in late 20s right now, by the 40s, probably 10 or 15 years.
Shashank, I tell you, if you are in your early 20s, and if you want to retire, you don't have to work till the age of 65. You can retire at the age of 45 or 55 because you have another good 20 to 25 years in front of you. Now, time is of biggest essence here. Time, once lost, cannot be recovered. So you have to make sure that you maximize time. A 20-year-old or a 25-year-old who has just graduated, has his or her a good job, is earning a decent income, can definitely start with $200, $250 or $100 plan, or diversify that. Okay, I have $300 to diversify. Now let me do how I can do my diversification, right? Because right now that person does not have any financial responsibility. He or she is just focusing on himself because he or she is alone. So now you could go maximums into it, do a 10-year pay or do a 20-year pay. You maximize you first have to focus on filling up your RRSPs and TFSAs, right? Because every year, because that's your limit. You have your limit. Every year you get 7,000, RRSP is 18%. So once you focus and finish up, or you max out your RRSP and TFSAs, that's when you can say that you have taken care of the registered accounts. Right? Now you focus on the non-registered accounts, which are your annuities, RIPs, LIPs, and many, many more, right? Now, these are some of the free accounts that you can get. As a 25-year-old, probably he or she is looking to buy a house in the next few years. So they can start a first home savings account.
What is this?
So first home savings account was introduced few years back. where a person who wants to buy a house, it is a combination of RRSP and TFSA, where you invest $8,000 a year. That's your limit. At the end of the year, you get your tax credit. So now your income reduces. You get tax credit at the same time. But this is exclusively for buying your first home. So now once you buy your first home, this account closes and you can't use it anymore.
Okay.
Right? So as a
that
25,
is helpful.
Yes. So as a 25-year, you always say TFSA, FHSA, RRSP. Once you have your kid, then you do RESP. Then you get into few other investment. So now you are increasing your risk profile. You are increasing your investment portfolio as well.
Okay.
Now you could do mutual funds as well, and you can see that what is giving me better. You can do a competition between.
So better to invest in various things when you're young, because the risk the risk capability is more, and you can take more hits.
Right.
Okay. Now let's get into the plus 20. That is
40.
Yeah.
So now let's say you want to retire at the age of 55. So
not 55.
50.
50,
right? Okay. So you have 10 years. Okay. So now from the aggressive stage, you start moving towards the moderate, and then closer to 50, you go towards the conservative. Another advantage of segregated funds is it allows you to do resets. Now, what is resets? Let's assume you invested 10,000 today, and after a month, it's sitting at 12,000 after all the gains that you had. Now, you can do a reset. So now your principal is not 10,000 but 12,000. So in case of a market downturn, your 12,000 is secured and guaranteed.
Okay.
Right? So these resets allow you to always increase, and then take advantage of those resets. Now, once you become closer to your 50, you can do switch. So switch from aggressive funds to moderate funds to conservative funds, because now conservative funds will give you 5 to 6% of return, but at least you're not going to lose money in a volatile market.
Now I've got a very weird question, because let's say when you're I don't want to ask that question. Anyways, so when you have disposable income in your hand, and because you said segregated funds, but then the platforms vehicles which I know are RESP, RRSP, TFSA and FHSA. Besides that, are there any other ways I can put more lump sum amount of money in segregated funds, and that way I can make work towards early retirement?
Right. So segregated funds also come under the insurance umbrella or the insurance company's umbrella. So through those companies, you can go into permanent life insurances and whole life insurances, which gives you a higher room to invest. Plus it gives you guaranteed returns as well as guaranteed dividends. So that's a completely different ball game that one can do. It's also very advantageous for business owners like professionals, doctors, dentists, where they have a good income source. They have maxed out their RRSPs, they have maxed out their TFSAs, kids investment are done. Now what's next? Yes, real estate. It is volatile. Go for it. If you don't want to do real estate,
real estate is also there. Besides
right?
that,
so you have these options where you have that. Yes, you are paying, depositing or investing, whatever you want to call it, but you have that protection coverage. At the same time, you have that investment coverage with a higher room to play around with. So now your room would be based on what you are investing, could be let's say 14,000 or 15,000 annually.
Will there be any limit in that?
There will be limit at certain point of time.
So non-free accounts like RESP, RRSP, TFSA.
Non-registered accounts, there is no limit. You can just play around with any amount.
I'm talking about that. So
non-registered you will be paying taxes at the end of the year when you start withdrawing it. Unless and until it stays in the account, there are no taxes involved to it. So these are called non-registered account, such as your annuity account, right? For example, or your just basic account, which is giving you a 10% rate of interest.
So you can, let's say if I have, I don't have that, but let's say if I have 350K, okay? And I'll take that, and how do I put that 350K into segregated funds?
So that is through the route of annuities. So let's say if you have this
What is annuity?
Annuities are again sort of, you get, for some people, if they have that 350K, they will just spend it in 1 month or 1 day or 10 days, right?
That's the reason.
Right.
Yeah.
So to save that or to stay away from that situation, annuities are, I want to put this 350K, I'm going to get X amount of rate of return, but I want money for the next 25 years, 4,000 monthly. So now you have a plan which is going to give you 4,000 monthly.
Who offers this annuity account?
So again, these are some of the financial institutions,
Okay.
not the financial, but
Not the banks,
Not banks also have it, but there are many more financial institutions.
Okay, so there is an option of annuity,
annuities.
Annuity where you can go and open the accounts,
Right.
and then you can plan that. Okay, I need monthly income of this much,
Yeah.
and through annuity you can put that
Correct.
in the segregated funds.
A good example is pensions. When people are turning 55 or let's say it's 65, they will have good pension, let's say 150K, 200K, and they'll say, okay, transfer this to my annuities. Now this account, 200K, is going to grow at 10%, and it's going to give me 3,000 every month for the next 25 years. If I die before that, the money will go to my beneficiary.
Because you are in segregated
Funds, yeah.
Oh, that's cool.
Right.
Awesome, sir. We are at the end of this podcast. So one final question, give me 5 pointers. In those 5 pointers, please mention to me, what a fresh job holder should do to succeed and retire early in life.
Number 1, start your registered accounts, which is TFSA, RRSP, FHSA, based on your risk profile. Before even that, I would say sit down with an advisor who can do your financial need analysis, your personal financial strategy, and then they can say that based on your goals, your risk profile, and your rate of return, this is what we offer. So that's one thing, because it's proven. A person with a financial advisor will make 3.5 times the money that he or she can make through an app or by doing him by herself, right? Because there are many things that you don't know. So that's first thing. Second thing is start filling your registered accounts, which is your TFSA, RRSP, FHSAs, which are these grants which are given by the government. So start using them. So that's number 2. Number 3, I would say, is diversify. Don't even just focus on one product, but you can go out in the market and decide which is best for you. Number 5 is not only focus on the Canadian market, but get out and go for global market, US market, Pan-Asia market in terms of equities and ETFs. And the last thing is, of course, have financial goals. Just like you have your personal goal, professional goal, having financial goal will allow you to work towards that goal and to reach that goal faster.
Wonderful. Thank you so much. Today I've learned a great deal of information regarding various, not specifically segregated funds. This is something new to me, to be frank. And I really appreciate your time here. Thank you so much, Amar. Hope to see you in the next video.
Thank you. Thank you so much.
Next podcast.
Thank you so much.
All right, folks. I just completed a great discussion with Amar. He was gracious enough to discuss about his investment portfolio and how things worked out well for him. Because he was, as you know, we already had a podcast about his career, which is project manager. Now we discussed a lot about investments and various options. I learned a great deal of information about segregated funds. I hope you also enjoy the conversation, which as I did. Thank you so much for tuning in. Please like, share, and subscribe.